Hello everyone, and welcome to our latest Finance in 15 discussion. I'm Steven, and joining us today are Josh and Melissa Stein. Thank you both for being here today.
Thanks, Steven.
Absolutely. Today we're going to be diving into some of the more pressing themes in the markets today. Trade tensions and tariffs, corporate earnings, the Fed, and what we're using to manage equity risk. So far this year, the S&P is down 3%, NASDAQ's down 7%, and the bond market's equivalent to the S&P 500 is up 5.5%. Josh, just real high level with the ongoing trade tensions, how are those affecting corporate earnings and market confidence right now?
Well, interestingly, I think corporate earnings in the first quarter were pretty strong, better than expected. That being said, the confidence in the markets, at least over the last month or two, have been shaky. So the tariffs have created obviously a lot of concern and a lot of turmoil, and we saw a sharp decline. And we'll talk more about the kind of recovery that we've seen so far, but in general, volatility has been pretty high. We've seen a huge spike in the VIX, which is pretty common when investors get fearful. And although a lot of that's calmed down as trade and tariff tensions have subsided a bit, I think overall, the overall sentiment is shakiness.
I gotcha. Melissa, anything you wanted to add?
Well, I mean, in general, just to expound upon what Josh was saying, I think, we've had a lot of volatility. It's not really any different than any other time. The market will tend to sort of overreact when there is something as uncertain as trade tension. It's not something we've had to deal with for a long time. So, a month ago, things looked a lot worse than they do today. I think a lot of people are surprised actually looking at their portfolios, especially our portfolios, because we've managed that risk, on the downside really well, that things aren't down more. And I think also the way this is playing out is that was probably like the most extreme reaction that the market had. Nothing's really changed, but, it looks like there's room for negotiation. And preventing these maybe trade wars, and maybe the result can end up yielding some positive results. I think the jury's out on a lot of those things, but the good news is that things have somewhat stabilized, but I think shakiness is really a good way to describe what is going on right now, and we continue to remain defensive in our equity positions especially.
Well, let's talk about that equity position. So as far as kind of where we're at today, is there any strategies that we're using that are kind of thriving in this current trade environment?
I mean, from a standpoint of hedging equities, we've been committed as a firm to using diversification for a long time. Bonds are actually doing their job this year. As Stephen mentioned, they're up about 5.5% year to date. So when stocks are down, bonds are up. There's typically an inverse relationship there, but we know that in extreme market conditions, that doesn't always hold to be true, which is why we've continued to employ other strategies, like alternative investment strategies and buffer products and other things to help continue mitigate downside volatility on equities, but not just using bonds. So diversification still works, asset allocation still works, but we've continued to expand what that means over the last 20 years. And we think that's the best way to help our clients combat volatility, especially our retired clients, or clients that are more conservative or just really can't handle this downside volatility. It's not always about all the upside, it's about managing the downside risk as well.
Yeah, that's a big point, Melissa. I'm glad you brought that up because different individuals have varying risk tolerance levels, and in particular, clients who are potentially generating income from their investment portfolios tend to have a different kind of risk overall perspective than somebody who maybe even is the same age but isn't drawing income. So you could call that investment time frame, but not necessarily maybe different in years, but just the need to generate income in particular, because if you have to liquidate positions to send income out, that can be hard when the markets are down. And so one of the things we've tried to do is start to segment those types of portfolios so that we can employ different strategies to help support what those overall goals are more efficiently. So what we really want to do is, for somebody generating income, really minimize the volatility measures as much as possible, even if that means giving up some upside, which I think most clients would agree with, because their primary objective is income, not necessarily growth, or some level of both, but not just purely growth.
Well, I think most investors would also be surprised to know how important it is to lose less money. There's a lot of value in losing less money. You're not digging out of a hole that's so deep. Also, what we try to do is exactly what an average person would do. What we try to do is exactly not what an average person would do, which is we don't want to make knee-jerk reactions to things based on the emotionality of something. For example, like the announcements of the tariffs or even a political situation. I mean, we really have to look at the data and then make meaningful adjustments to our portfolios to minimize risk, but we don't want to go too far, right? If you just put all your money in bonds or cash and then the S&P surges, that really doesn't help us either. So we have to be careful about those decisions, and mitigating risk is definitely our number one concern.
And then maybe just if you could kind of walk us through our quality overlay real quick on the equity piece before we kind of switch gears a little bit. So I'll let you kind of walk us through that.
Sure. So and we've talked about this in prior discussions in the past, but for quite some time, several quarters now in a row, we've really been kind of moving and stretching more towards what we call quality, which is making sure that the companies that we own are positioned well for difficult times per se. And that can be hard, in particular when so many investments are just so heavily tied towards the Magnificent Seven and just the overall amount of weight that those companies have on the entire market. You really have to get a little bit more creative when building portfolios, or otherwise you're just so heavily invested in a few companies, which also arguably tend to be pretty volatile, in particular in times like now. So in particular, we've really been focusing on spreading out that risk to what we call a quality overlay. And then more recently, we've utilized some additional strategies that are called buffer type investments that really are using things like stock options to manage risk. And sometimes when people hear the word stock options, they think risky. That can be true if you're using them in a risky way, but if you're using them in other ways, they can actually be very conservative. And that's the way we're using it, to almost fill in losses on the downside. And what I was alluding to before, you might have to give up a little bit of potential return on the upside, but what you do is you really get an opportunity, if the markets are dropping fast, to preserve some of your investments. And we think, in particular, just not necessarily knowing how large this tariff issue would get, it was a decision we've made to add some of these buffers into our more conservative type portfolios and our more moderate type portfolios, just for some added downside protection.
Well, and it's not just the tariffs. I mean, you overlay the tariffs over, we've been in sort of a sustained high interest rate environment.
Yep.
I mean, when you look at how that impacts profitability, I mean, like higher interest rates equals higher costs.
Yep.
For everybody, usually. Also, like a higher inflation environment. I mean, inflation is kind of remaining sticky. We, hear the word stagflation a lot. Fed has, just said they're keeping rates steady. So it doesn't look like that's coming down.
Yeah.
At least, yeah. Eventually it will. But I mean, just looking at where the economy is, like, is it heating up or cooling off in general besides the tariffs? I mean, I would say it's probably cooling off. I mean, we've kind of had that mindset for a while, especially after it's sort of like the normalization from all the stimulus and everything, which was 5 years ago now, but it took all that time for that sort of extra to get sucked up into the system. So now, we have an environment where maybe profitability isn't going to be as high as it was. And that's when stocks make money, right? When profitability is higher. And so we've remained cautious and wanting to be in some of the best companies that will be able to navigate that, as well as even, a higher tariff situation.
Yeah.
I mean, good companies will have the resources and money to be able to navigate a changing environment with tariffs. They're going to adapt to it, and they're going to continue to be profitable. Ones that aren't as well positioned, they're not going to do as well, and that's the other point of the quality overlay. So, I think our sort of thought right now is to be cautiously optimistic, but also to be, I think diversification matters, and probably even, more sort of individual selection of securities matters right now.
And this is a tough time. We just went through this really massive sharp decline, and then kind of arguably a really massive sharp recovery. And the question is, what's next? And there's a lot of headwinds still. And I think our sentiment is that we're not necessarily out of the woods. And it's more important, I think, to be safer than it is to be greedy right now. because although it feels good to see the S&P and other indices really making somewhat of a recovery from the kind of the Liberation Day drop, but you don't want to be faked out by that and then go back to maybe being more aggressive than you were before, or even just thinking that, hey, we're ready to rally here when there's still a lot of other challenges economically that need to be worked out. And so I think part of our philosophy is to not kind of get blindsided by small recoveries or even larger recoveries, and looking more towards the next step, which is will we be on the brink of a recession? What are earnings going to look like when tariffs are kind of actually being implemented? How does that impact inflation? And what are the next kind of steps that happen between now and then with the markets? So
I think it's really important to note too, and I think even the last 45 days is a perfect example of this, is this time isn't really any different than any other time either. I mean, it's always a different sort of stimulus that's impacting the market, but basic investment strategies and principles, they don't change. And I think just seeing how things, we had this extreme drop and this extreme recovery in just 45 days. I mean, some of the worst things we could have done is like sell out and put our clients' portfolios into cash or done something extreme like that. It is when you have a good investment strategy and process like we do in our investment committee, which Stephen's going to speak about a little bit, and ongoing monitoring and management of portfolios using common sense, data and data. I mean, you don't have to always make a knee-jerk reaction or adjustment to these things. Sometimes staying the course or just continuing with that strategy makes the most sense, and it's the best thing that you can do. And I think over the last 20 years, so many investors have thought, oh, well, this time is different, or
it always feels different, right?
or I always need to make a change to make something impactful in my portfolio. Well, if you had a good investment strategy to begin with and it made sense for you, likely that even if something's happening in the short term, if you zoom out and you take the long-term approach, that it's going to shake out and it will continue to be effective. And I think that that's just really important in these environments, is we don't always have to react to every single thing that happens. It's actually probably not in our best interest to do so.
That's why when we say when in doubt, zoom out, because that volatility that we experience on a day-to-day or week-to-week, even month-to-month basis tends to be somewhat relatively forgotten over time. And if you go back and even look at the frequency of 10% market declines, they're way more frequent than most investors would remember. It's just
when they have a lot of focus on them, or they're being covered by the media, they tend to get more attention. But other times you might not even notice if you don't look at your portfolio.
No, in fact, one thing that we've been talking to a lot about clients is if you just pull up historical S&P 500 returns, calendar year returns, but then look at intra-year lows.
Yeah.
So what happened not just from the start of January to the end of December, but in between those periods of time, where did the S&P hit a bottom? Almost every single year, it's negative.
Yeah.
So at some point in the year, and in many years, it's double digits negative. It just doesn't necessarily end December 31st negative, and so it kind of tends to be forgotten. So the argument then becomes, well, if the markets are ever negative and you're going to sell or do something reactionary, you'd never get a chance to be invested, right? Because we don't even necessarily pay that much mind to it, but the volatility on an intra-year level is more than I think a lot of people recognize, which is good that they don't necessarily focus on it too much. But when it's in our faces in the media, and when we see it in our quarterly statements, and it's kind of overall everywhere, it just becomes so much more recognizable.
So there's a lot going on in the markets, and with all this in mind, we like to remind clients that most of what we do is actually behind the scenes when we're not directly meeting with clients. One of our cornerstones of our processes is our bi-weekly investment committee meetings, where we take a look at what's going on macroly, and from there, as we get and collect data, we make timely and tactical adjustments to portfolios, normally on a quarterly basis. But with all this in mind and everything that's going on in the world, we're always here for our clients, and we're always making decisions and adjustments, to your portfolios on an ongoing basis.
We encourage everybody to reach out anytime you have any questions. We hopefully will be reviewing this in our regularly scheduled meetings, but if there's anything that anybody would ever like to discuss in between those meetings, we're always available. We always have time to discuss anything from how the watch works to just what time it is. So.
Well, that's it for today's Finance in 15. Thank you all for joining, and we'll see you next time.
Thank
Thank you.